Welcome everyone to Crypto Defined for February 9th. My name is Kathy Chu. I'm a former Wall Street Journal and USA Today reporter. Now report for Truth DAO, a new nonpartisan journalism organization within a DAO. You can visit us at truthdao.xyz. Please join our Twitter, Discord, and Telegram communities for more information. Today's guest is Ram Ahluwalia. Ram is the co-founder and CEO of Lumida Wealth Management, a crypto-native investment advisor specializing in digital assets. He is also a certified financial analyst who has published detailed blogs and threads on Twitter about everything from where the crypto market is headed to the latest developments in the bankruptcy case of Genesis Global, as well as the Celsius bankruptcy examiner's report. Welcome, Ram. Thank you so much for being here with us today.
Thanks for having me, Kathy, and appreciate everyone's patience getting through the technical challenge.
I appreciate you bearing with us and everyone else through the technical difficulties. Well, Ram, there's a lot to talk about. Wanted to talk to you about Genesis, but before we do, wanted to just ask you about the crypto markets. The crypto markets are rallying intermittently. Bitcoin alone is up 39% this year. Jim Cramer, I don't know if you saw his tweet in January, he said that the manipulation higher of crypto shows you that this is truly a sham market. Wanted to ask you about that. What do you think of that statement, and where are your thoughts on where the crypto market is headed?
Sure. Well, I think if you want to look at crypto, you've got to look at a higher level market because crypto is trading in correlation to other risk assets. So Bitcoin has rallied in lockstep with highly shorted names, including Coinbase, Peloton, and other recent IPOs. So that is what you want to do is to get a point of view on Bitcoin, you got to get a point of view on risk assets. And to understand a point of view on risk assets, there are two competing forces at work. And I'm actually talking about this tomorrow at an 11 a.m. Twitter space. So stay tuned for that. We're going to share a macro outlook. But here's the high level way to think about it. In 2021, with high levels of inflation, the Fed announced that they were raising rates. And of course, they've raised rates at the fastest pace we've seen since 1981, when Paul Volcker was combating double-digit inflation. And so you had the macro crowd led by folks like Bridgewater, world's largest global macro hedge fund, that were short and did very well the first 9 months of the year. This recession, though, is also the most telegraphed recession we've ever seen in history. If you ask CEOs whether they think we'll be in a recession or not, 98% will say yes. You also had record short interest, both in equities. Goldman Sachs Prime Brokerage Report indicated that this short interest with the 99th percentile over the last 10 years, and third, in the futures market, you had record short interest. So the point is this: you had a crowded short bet due to this telegraph recession, and essentially you've got this competition between the macro folks that are expecting deterioration in the real economy, and for that to show up in the pricing of risk assets, competing with a crowded trade. And of course, since January, we've seen a counter trend rally that's been sharp and furious. That's kept a lot of people surprised. And that's what's led to the recent, Bitcoin rally.
And do you expect this to continue? And to what extent do you think the bankruptcies of firms like FTX and Celsius will play into any of these the crypto market movements?
Sure. I'll give you a way to think about it so you can arrive at your own conclusions. I don't want to give financial advice here, but here's a way to think about it, right? So in October of 21, you had peak crypto prices. And what were the two things that happened in October 21? One is you had El Salvador accept Bitcoin as a form of payment. That was one. And second, you had the launch of a securities exchange security backed by Bitcoin futures. By the way, that latter event also happened in the 2017 peak of Bitcoin. Whenever you get these climactic moments, you get peak hype. And that's what happened October 21. Of course, November 2021, a month later, you had a peak in equity prices. That was the same month that the FOMC, which you can see in their meeting minutes, started discussing rate hikes in response to inflation. Now, fast forward 1 year to October 2022. So what happened? You had the collapse of FTX, and then a few weeks later, you had the collapse well, you had Genesis stopping withdrawals. So what happened there is we had peak fear, and Bitcoin got down to around $16,000 or so. Uh, and Bitcoin's rallied from that $16,000 to 22,000 and change. But what's the lesson? You've heard this investment expression: be greedy when people are fearful, and be fearful when people are greedy. And that has played out to a T over the last 12 months. That's a big picture way to think about it. It starts to bring together sentiment and positioning with the macro story. So, like where we are now, imagine like a pendulum. There's a pendulum where we were at peak hype, October 21. We're at peak fear, October 22, November 2022. We saw 2 months of bad news or hitting the market, but Bitcoin and ETH and other digital assets were still hanging in there, indicating that the bad news was priced in. Anyone who wanted to sell had sold. There's no one left to sell at that point. And then you started to see these record put call ratios, meaning people buying insurance, record short positions. And that led to the current market. I think where we are now is the pendulum is just past the middle of the swing, meaning there's more discussion of soft landing. Equity markets have rallied. There's a perception that Fed Chair Powell is being more dovish, and Bitcoin does respond to that kind of commentary. So, this recent thrust has real momentum behind it, has real breadth, real market internals. You can look at like advanced decline ratios, the nature of the short covering. So it could go on for a few more weeks. The easy money's been made on this short covering, though. Um, and it's hard for me to see something like the S&P 500 staying above 4250 on a sustainable basis. And that would, there's some correlation there to Bitcoin.
Right.
So,
And it will be interesting to listen to your macro outlook tomorrow, which is February 10th, everyone, on Twitter Spaces. We will be tuning in. Well, let's chat a little bit about the bankruptcy of crypto lender Genesis. You have been at the forefront kind of tweeting about some of these developments, but I think also tweeting about it and blogging about it in a very clear way that everyone can understand. I think a lot of people are writing about this, but I found some of your tweets and questions that you pose to the Twitter community, some of the sharpest out there in terms of very thought provoking. So, Genesis, for those who may not know, I believe everyone knows at this point, but is part of a conglomerate called DCG, which also owns other entities such as CoinDesk and Grayscale. You've published a lot of interesting threads about it. Let's talk about the potential impact of this on the crypto world before we get into the nitty gritty. Before Genesis was filing for bankruptcy, some people had talked about how the ramifications of a Genesis bankruptcy could reach further and wider than even FTX. And I wanted to get your thoughts on that. Would you agree or disagree? And how is it playing out so far? I mean, we're
sure.
still in the beginning stages of
Yeah.
this bankruptcy.
Yeah, it's a great question, Kathy. And first off, just to give you all a bit of background, my team and I, we come from TradFi, but we see the promise of crypto. In the financial crisis, I was at Merrill Lynch, which blew up to balance sheet issues around subprime securitized products. So, we've been around a couple of cycles, and we've got some world-class investors as well that come from global macro funds. So there's a team of people, a lot of insight that I get to ride on the shoulders of, which is great. Um, but yeah, so FTX and Genesis are very different in terms of the impact. FTX impacted primarily international, one, retail, as well as institutions that wanted to trade in swaps and in spot markets using the capability that FTX offered. Genesis was, and maybe still is, depending on how you look at it, is one of the world's largest crypto prime brokerages. And what a crypto prime brokerage does is they offer custody, they offer trading, they offer credit or financing for various positions. So their customers are large institutions, as opposed to FTX, which might have some large institutions, but generally there's millions of customers and retail customers involved. They're better positioned against, like, say, a Coinbase. So Genesis has more concentrated uh, customer activity. And obviously, one of those customers was 3 Arrows Capital, which their blow up, set across a chain of events. as well. So, look, the Genesis contagion risk, I believe, is largely behind us. We've seen the creditor docket. There are no new big names that appear there. So it's hard to see what the next domino to drop is because there should be a large balance that's outstanding. And from our analysis, what we see is it's kind of like a credit loop. You see BlockFi, Three Arrows Capital, Voyager, FTX, and Genesis, and they were borrowing and lending to each other. Three Arrows Capital blew up in part due to this GBTC trade, and that was a domino that knocked down these other dominoes. So that's where we are today. It's hard to see further contagion coming out from the Genesis collapse.
Would you say that most people would agree with that statement? Because that's a very positive thing if it's hard to see any further contagion coming out from Genesis. Would most
I haven't
analysts
seen
agree with that, do you think?
I haven't seen anyone talk about it, yay or nay, because I think we're the ones analyzing this. I'd love to get another take. I think people would agree with it. Where people are focused is, well, what about Binance and what about Tether, right? Those are some of the open questions. And the other question that's coming up in the last few days is, hey, there's this like bank deplatforming of Binance. What does that mean? But none of that is related to credit contagion from Genesis, nor is it related to credit contagion from FTX. There's a very different set of causes and effects that'll happen. Credit contagion is very serious because one day you think you're solvent because you've got your funds deposited at what you think is a bank that's safe and sound, like Genesis, and the next day you're not, and then you owe money to people because you're borrowing, and suddenly they're insolvent, and that creates a very harmful cycle. Of course, we saw that during the 2008 crisis. It seems like that's largely done. So yes, that is good news. That's good news. But there are other questions out there because there's lack of transparency around the balance sheets of other systematically important institutions.
Right. And just thinking about the macro crypto economy, I mean, it's interesting. And I'm sure you'll cover a lot of this in your macro outlook tomorrow, but there's so many moving parts. It's kind of hard for even an insider to kind of track everything. I mean, you think about the idea that a lot of this credit contagion risk is behind you. So that's a good thing for the market, the certainty, as well as with FTX as the case winds keeps going on. But then you think of the possibility of other dominoes falling elsewhere unrelated to this. And it's mind boggling in a way, kind of keeping
Yeah.
track of everything.
Well,
So
just
I
to
am looking
clarify, like,
forward to your macro outlook.
sure, I want to clarify one thing. You could certainly see smaller international exchanges blow up.
Right.
Okay. Like I have questions and concerns around Nexo. I've published since the summer, and there's some AML actions around them. And there are other smaller international exchanges that could very well blow up. However, those are not systematically important institutions, so they won't impact the price of Bitcoin. That's a distinction. And I would encourage you all to level up to the most regulated, trusted, centralized exchange possible, right? There are two paths in crypto, either fully decentralized, where you control your keys, uh, and you're going to be safe there. You got OPSEC, InfoSec, security, other set of security issues and concerns to address. That's one approach. The other approach is regulated exchanges, regulated CeFi. What you can't do is this middle ground of unregulated CeFi, where you had the Voyagers, Celsius, the BlockFis, and the Genesis of the world hold themselves out as banks and act like banks, but they're not banks. They don't have FDIC insurance. They don't have a lender of last resort. They don't have stringent capital requirements, reserves, and liquidity ratios to offer those kinds of services.
Right. Thanks for clarifying that. I appreciate it. Okay, let's talk about the latest developments with Genesis. This week, Genesis and its parent, a digital currency group or DCG, reached a tentative agreement with some of its main creditors that could allow creditors to recover some of their money. There were other proposals that had been on the table before, and we'll get to that with the Winklevoss twins. But can you walk me through your understanding of how this tentative agreement works to the extent
So
that we know?
right. So we haven't seen the term sheet uploaded to the bankruptcy docket. The lawyers convened with the judge, I believe it was on Monday. They said it'd be posted within 24, 48 hours. Well, it's been 72 hours, not there yet. So what that means is the lawyers are still working out the finer points in the term sheet. and that is why we haven't seen that. There's some public reporting on some of the features of it, and one of the ideas that CNBC, I believe, reported on is that there's contemplation of the equitization of the $1.1 billion promissory note. We'll come back to that. That means, in short, it means that unsecured creditors to Genesis, which is much of the people that have a deposit in Genesis, would own a chunk of DCG. You have an equity interest in DCG. That's one. Second, it looks like there's this, it's called like a convertible preferred security that investors would have. And the way that works is essentially the creditors would have an interest in a form of debt, and that debt would accrue an interest and it pays out a coupon. However, it also has the right to convert to equity if the investor wants to. That's interesting because, see, let's say DCG goes public one day or gets acquired, then the creditors get to choose the best of both worlds. Like, likely, if they go public, then the equitization will be a better payoff than just getting some interest rate which hasn't been disclosed yet to the public. So it's a nice feature, but we don't know the terms of that either. So we need more clarity around that.
Right. And how does this differ from what the Winklevoss twins had proposed? The Winklevoss twins, for those who don't know, I'm sure that most people know about them at this point. They became first known for their battle against Mark Zuckerberg, of course, over who had the idea for Facebook. And they're big in the crypto world. They're founders of Gemini, a crypto exchange that happens to be a creditor of Genesis. Um, and under the proposed deal, I believe they will contribute up to 100 million in cash. Is that right, Ram? And that's
That's
earmarked for their customers of the Gemini program. Can you talk a little bit about that and talk about their relationship, Gemini's relationship with Genesis, and why
yeah,
you think the Winklevoss twins agreed to this deal? I mean, the term sheet is not out, of course,
right,
but
right.
based on what we know so far.
Yeah. So there's public reporting that Gemini offered $100 million, I call it a kicker, to motivate creditors to accept the deal. I would fully expect that for creditors to participate in the $100 million kicker, they will have to waive all claims against Gemini, meaning if you're part of a class action lawsuit, you're going to have to drop out. So it's a sweetener that Gemini is introducing, one, to help creditors get closer to being made whole. We'll have to see whether they can, in fact, be made whole. It doesn't look like they can be made whole up front. That's why equitization's on the table, right? Um, and second, we have to see, well, what claims are released. So that $100 million kicker will only be available, I expect, to participants in the Gemini Earn program. So if you're in Donut, you're not going to participate in that. You should ask a Donut for that. You should say, look what Gemini is doing. What are you guys going to do? And also, if you're an unsecured creditor to Genesis directly, then you would not participate in that. I should also add, in the Genesis proposed approach, DCG would also have their own kicker. So, and that kicker would be made available to program participants that went directly to Genesis. So you can't get both kickers. It depends on how you were offered the program. If they're offered by Gemini, Gemini Earn, here's $100 million, you're gonna have to release claims. If you came in through Genesis, then DCG will have a kicker as well. The amount of that is unknown. We have not seen that, but I would fully expect that to be here as well.
Right. And so those details should be coming out in the next week, correct? About the details of
Should
these
should
kickers.
be like yesterday. It should be here 2 days
So they're
ago.
a little late.
So we're
I mean,
waiting.
is that
Yeah.
concerning at all that it's not out at this point, Ram? Is there any concern that if it is not out, and the longer that there's delay, that there could be a hiccup and that this might be scrapped?
No, I look, there's it takes time to get to the finer points before you put something to the docket. It means there's more legal fees being paid. I think someone made a joke that if I could get a token linked to Kirkland and Ellis, that thing would be going up in price. That's probably true. That's a joke, by the way. Don't go buy any tokens that are unregistered. So I'm not terribly concerned about that. The delay. It's important that Gemini and two major creditor groups and Genesis came together around a deal. It's very important. Why? Because one, it ratchets down the temperature. there's a lot of litigation talk going back and forth. Recall in December, Cameron accused Barry Silbert of of all sorts of egregious behavior and allegations of fraud, right? So it takes the temperature down and it drives towards a resolution, and there'll be less legal fees based on disputes and the going back and forth. For example, there's this question around the GBTC that DCG pledged to Gemini, which was liquidated on the day that Genesis suspended withdrawals. If you have clarity and parties are aligned, then those disputes go away, the legal fees go away, and there's going to be less litigation, means more in the economic pie. It creates more clarity, a faster path to resolution, and a payout for the creditor. So it's a very good development to see that.
So, back up a little bit. I mean, there's a lot to unpack in what you said here. I think GBTC, just in general, is a very important topic, and you've talked about this before in other podcasts. GBTC is the Grayscale Bitcoin Trust. It's like kind of the cash cow of one of the cash cows of DCG, right? So, talk a little bit about why GBTC was an issue between Gemini and Genesis, and why it's such a big issue in the crypto world in general. It seems like you hear about GBTC in a lot of these failures, and
Yeah,
there is
yeah,
some common thread. So, could you back up and just
sure,
go over
yeah.
that a little for
Let me
people?
introduce that. So GBTC is ground zero to explain the failure of many of these institutions in the crypto world. So as you pointed out, Kathy, GBTC is a security issued by Grayscale, and Grayscale is owned by parent company DCG, and it's a cash cow. You know, at its peak, Grayscale, by my estimates, was generating something like 800 million in revenue with a 65% profit margin. Okay, so $500 million in net income, and that enabled DCG to do all sorts of investments and other things. And one of the things DCG did was they bought GBTC. So they took the free cash flow from Grayscale, and they turned around and bought $780 million worth of GBTC. We know that through public filings, 10Q statements require disclosure. They also borrowed from their other subsidiary, Genesis, right? So DCG gets a bunch of cash flow from Grayscale, then they turn around, buy GBTC, and then borrow from Genesis. A whole cast of characters and a very complex family here. Also, Three Arrows Capital was doing the same trade. So Three Arrows Capital borrowed $2.3 billion from Genesis to buy GBTC on the belief that the discount in GBTC would narrow. Again, GBTC is a way to access Bitcoin through the convenience of your brokerage account, but it can trade at a premium or at a discount to the underlying net asset value. And it had been at a premium for 4 years and a 30-50% premium. In fact, it was a great generator of economics for businesses like BlockFi, which would buy Bitcoin, deliver it to Grayscale in 6 or 12 months' time, and then capture that premium. So what happened is that spread continued to widen. The discount widened. Three Arrows Capital got a margin call. Three Arrows Capital could not pay back their obligations owed, and Three Arrows Capital allegedly double pledged the same collateral to multiple counterparties, which is a form of fraud. Uh, and that led to Genesis taking down a big impairment. But that GBTC was really the first domino to take down a lot of actors in the ecosystem, more important even than Luna.
So,
Now, go ahead, Kathy. Yeah.
no, I was just going to ask that um, it seems like Three Arrows Capital, a lot of these crypto firms counted on GBTC being basically the SEC approving the application for an ETF,
Yeah, that's
and
a really good point. Yes.
it makes me wonder if the SEC had approved this application, would we have seen all these dominoes falling, or would
It's a
firms
really
such
good.
as 3AC and others still be solvent, and we would be in a kind of different world? I
Yeah,
wonder,
you know,
right?
it's really great point you raised. Look, if the SEC had approved the ETF, then GBTC would have converted to the ETF, and the discount would have gone away, and certainly Three Arrows Capital would have blown up. However, so you're right. It's a great point. However, it's alleged that Three Arrows Capital committed fraud because they were double pledging their assets to multiple parties. So what double pledging mean, by the way, is like when you get a house, you get a mortgage, you've pledged your house as a form of collateral to the bank. So if you don't pay your mortgage, the house will be foreclosed upon by the bank. Okay. But you can't pledge your house to multiple banks. That's illegal. It's called mortgage fraud. By the way, that actually did happen in 2008. People did pledge their house to multiple banks. Doesn't happen anymore, right? So one of the things that these markets are doing now is correcting the excesses out of the system. So in some way, look, it's awful to see Bitcoin go down in price, and it's awful to see the carnage, especially when good actors are taken out and lost money or have trapped funds on Genesis. That's terrible, right? And Gemini, etc. The other side of it is that, when liquidity leads a system, there's this expression, when the water goes out and the tide goes out, you see who on the beach is naked. We're seeing that. You can see Alameda was naked. You can see FTX was naked. You could also see that Three Arts Capital was naked as well. So it's been a bit of credit flushing of these bad actors.
Do you think there's any chance at this point that the SEC will approve a Bitcoin ETF? I mean, that's there's lawsuits going on right now, right, to kind of force this. Do you have any thoughts on
It's
whether?
a it's a good question for securities lawyer. I'll tell you both sides of the argument. So Grayscale has filed suit. They've retained the former Inspector General of the United States. The Inspector General is the chief lawyer for the United States, and they make cases in front of the Supreme Court. Very sophisticated individual, and there's multiple amicus briefs from credible attorneys saying that the SEC should approve this on the grounds that the SEC did approve an ETF backed by Bitcoin futures. And there's some other arguments there as well.
Right.
So they're saying, hey, SEC, you approved this ETF backed by Bitcoin futures, but you're not approving this product backed by Bitcoin spot. So we'll see. Now, the SEC is saying that the spot market is subject to market manipulation, that price and volume can be manipulated, and there's wash trading. And there is a lot of wash trading, to be clear. So, I'm not a securities lawyer. It really is, you got to get legal advice to assess that. But there is a litigation process underway, and I think in March we'll hear the first hearing from a judge, and we should get resolution on that no later than in November of this year. So that's a key thing to watch. If you own GBTC, and that concludes favorably and it converts to ETF, then that's great for GBTC. But look, I don't have a view on it. It's hard for me to assess. We'll see. Look, the FTC had overreach. You might have seen that. They had an antitrust action against Google. The judge said that was an overreach. Google prevailed. The FTC is not the SEC, though. This is it's
Right,
a very
right.
different set of circumstances.
Well, as a digital asset, advisor, what do you tell people when they think about the idea of market manipulation? Because that market manipulation is central to why the SEC won't approve a Bitcoin ETF, but it's also central to the idea of, for some investors, whether they decide to get into the crypto market or not. And I think I mentioned that, what was it, Jim Cramer had said, what was his quote earlier in January? He said, the manipulation higher of crypto shows you this truly a sham market. He's saying because things are the crypto assets prices are going up, he's calling it all manipulation. I mean, when your clients come to you and ask you about
Yeah.
manipulation in the market, how do you respond?
Yeah. There are tools and infrastructure providers coming online like Chainalysis and quite a few others that are designed to detect and prevent wash sale trading. So, you know, that'll help improve market integrity. You're already seeing leading exchanges like Coinbase already adopt that today, but international exchanges are not subject to US regulation. So look, it's difficult because no one has the God's eye panopticon view to legitimately answer the question. There's wash trading. There's no question about it. You can see an international exchange, but does it materially drive the price of Bitcoin? Bitcoin is far more liquid now than it was 5 years ago. I think 5 years ago, you could argue there's more prevalence or opportunity for market manipulation. Uh, Today, liquidity has dropped in Bitcoin over the last 6 months, so a large buyer can move prices. Is that manipulation? I don't know if that's manipulation. That's just the fact there's limited liquidity. So, these are, I'm trying to parse your question but it's, these are very nuanced, considerations to
Right.
work through.
But
But
as
here's,
you mentioned,
yeah,
it's there's still manipulation out there, but the thing to think about is whether it's enough to basically move the market and whether
right,
it is
right,
enough to basically force the to for the SEC to use as justification for not approving Bitcoin
right.
ETF. I
I
think those
don't
are the
know
important
that.
questions people have to
I
ask.
Right. I don't know that there's manipulation in Bitcoin or ETH to be clear. I don't, I first, I literally
Right.
don't know. These are larger markets and there's more liquidity. Smaller tokens for sure are easily manipulated. Right. Like these are just pump and dump schemes and you have a Discord group and you have like a promoter and of course that happens. You see that, right? So just be aware when you see that. But here's the other flip side of it is that if the SEC brought crypto assets into the regulated public markets, you could say that'd be harder for market manipulation because you're going to have far more liquidity and you're going to have more market actors involved. Imagine if Goldman Sachs and JP Morgan were making markets on Bitcoin, for instance, or imagine if you saw more institutional adoption from hedge funds. And you're already starting to see that now, by the way, despite the recent issues, not just the Brevin Howards of the world, but and others. So that's the flip side of it, right? So if you bring it into the regulatory fold, then that's a way to crowd out the bad actors.
Right. And that is the same argument that Grayscale and another firm, Bitwise Asset Management, which is also pushing for a Bitcoin ETF. That's the same argument they've made to the regulators that there will be less manipulation if they approve an ETF, a spot ETF, just like they approved the futures. Okay. Well, thanks for your thoughts on that. Want to go back to Genesis just for two more quick questions.
Sure.
As you have mentioned, Ram, there are a bunch of open questions here, such as the value DCG, creditors will get an equitization. What dilution does this mean for DCG?
Right.
Will DCG give up board seats to institutional creditors? Wanted to ask you, we talked about the first question a little bit, but any thoughts on the dilution or
Yeah.
whether DCG will have to give up board seats to institutional creditors?
Great question. So yes, there's going to be dilution. I saw reporting that DCG attempted to raise at a $2.5 billion valuation a few months ago. That's down from a $10 billion valuation in November 21, which was peak market when Grayscale was throwing off, call it 800 million in revenue, right? So is the valuation 2.5 billion? Probably less because there's more litigation out there. There are these open issues. There's an SEC enforcement action that's likely to happen, which could force customer restitution and a fine. So it's very hard to value DCG. And the creditors will get a number. There's going to be some conversion ratio. It's going to say, we think DCG is worth this. And we're going to see that number. We want to see what that number is and analyze that very closely. Now, what's the amount of dilution? Well, it's the dilution is going to correspond to the amount of equity DCG needs to give up to help creditors get back to being made whole, right? So it looks like there's a $400 million hole just in Gemini Earn, meaning that the overall Gemini Earn exposure is 800, $900 million. Uh, However, if you look at Genesis's balance sheet, it seems like there are other liquid assets there, et cetera. It seems like the whole is $400 million for Gemini Earn. So, if you do some quick math, $400 million divided by $2 billion. And by the way, this is likely to be completely off because we really are working in the dark. We don't see the full set of
Right.
obligations. We don't know the conversion structure. So this will be wrong. What I'm about to tell you is wrong, okay? But it's an informed best guess given the limited data I've got. But it's interesting to think about. So $400 million on, call it a $2 billion valuation. What's the math on that? 20% dilution? 20% dilution is typically what you get when you raise money, actually. So that's not unreasonable. And I would expect that institutional creditors do get at least one board seat. I would expect that they have that. And also, this activity of equitization will force alignment. Right now, the creditors are, again, they're litigious against DCG, but you don't sue the company that you own, right? So, equitization is going to help, again, lower the temperature and bring people to a common resolution.
Right. And you can find a lot of Ram's threads and analysis on his Twitter feed. I just want to mention, Ram, we tried to get a bankruptcy lawyer on with you. And what I found interesting was as I approached a lot of these lawyers, they were either in talks to represent some party in the bankruptcy proceedings, or they hope to be in talks. So in some cases, their legal and compliance departments wouldn't allow them to participate. But I thought that's very interesting in and of itself, because you can kind of see this feeding frenzy of all these bankruptcy cases, and how it's drawing in all these bankruptcy lawyers, a lot of them who have not been in crypto before, but are now getting into crypto. And there have been a lot of articles about that. But so
Yeah.
I just wanted to mention that. That's why you might not see a lot of bankruptcy lawyers. Some of them are opining on Twitter, but a lot of them are not. So that's why Ram's Twitter feeds and those of other analysts are very valuable.
Well,
Okay,
the
so
lawyers, yeah, the
I just
lawyers have
wanted to
no
ask you one.
upside. Go ahead,
Oh, so
please.
go ahead, Ram.
No, I was just going to say briefly, the lawyers have zero upside in providing any insight. They either give up fees or they get it wrong. And to get it right, they've got to do dozens and dozens of hours of research, and to what end? So lawyers won't say much.
Right, right. That's a good point. I would like to ask you about the Celsius Examiner's Report, but I wanted to ask you one last question about DCG. There was an article in the Financial Times saying that DCG has begun to sell its holdings in crypto funds managed by Grayscale Investments, specifically Grayscale's Ethereum fund, for about $8 a share. How important is this, Ram, and how do you think about DCG and its need for asset sales in general going forward?
Right. So DCG needs to generate cash. It needs to generate cash because in May it has an obligation to pay approximately 575 million to its subsidiary Genesis. Because again, it borrowed from Genesis to finance GBTC and these other assets. So 575 million is in 3 months' time. It's coming up soon. So, well, how do you generate cash? You can generate cash flow from operations. That means Grayscale. Grayscale's maybe throwing off 120 million in free cash flow, but DCG's got to fund all these other businesses as well, and it's overhead, right? And it's I don't the net free cash flow after all that we don't know, but it's not enough to pay $575 million. And then the value of the other tokens held on their balance sheet has been dropping, like Near Protocol, GBTC has declined. So that's why DCG is forced to sell assets. You saw in the market that in the news that DCG is attempting to sell CoinDesk, for
Right,
instance. So you're going to see more of that. You will see headcount reductions. It's very unfortunate, but DCG needs to do these things to avoid defaulting to the subsidiary. I expect DCG will be able to honor their obligations, so I do not expect DCG to go through Chapter 11. If they did, there's a whole set of other things we to analyze, and we
right.
don't want DCG to have those issues too. It's not good for the crypto sector. We need to root for DCG to get to the other side, but they will be paying out a lot of cash flow to creditors for many years to come.
Right. And then the next week will be very interesting. So my last question for you, a big topic, but I was wondering if you could opine on it briefly. The Celsius Examiner's Report. Again, you had a very thoughtful thread about the Celsius Examiner's Report. I know you've read through parts of the report, the executive summary, I
Yeah,
think in
right,
total 450 something pages.
right.
What interested me is that the examiner said that base Celsius was basically insolvent from the beginning, continued to be insolvent, even though it basically had this flywheel scheme where it pumped up the price of its token, sold and bought tokens as needed, used this as collateral to pay deposit holders. So, what I wanted to ask you about is what are your thoughts on this finding? I mean, are you surprised? And it brings up the bigger question of, if Celsius is doing this, how common is this in the crypto industry?
Phenomenal questions. Let's go through each one. Each one is a juicy topic. First
It
off,
could
I'm
be a
not
whole nother
surprised.
broadcast, so I'm sorry I
It's a
brought it up at the
really
end, but I needed to get your input
no.
on that.
I'll give you a framework to help identify these in the
Sure.
future, right? But first off, I'm not surprised. So I have the infamy of being the last person to be on a public panel with Alex Mashinsky at the end of May before they blew up. It was me, a moderator, and Alex. And I was asking Alex very direct questions, and he was saying we have proof of reserves. I know that's BS. I know, and like the thing is, the
How do you know
audience
that's
and the
BS?
public, because there's no blockchain where you can see the proof of reserves for Celsius and the proof of liabilities at the same time with a third party attestation and an audit firm. You need all of that together. But he would make these comments out of without substantiation to the public. And there are other, when I was at Cross River, I built a crypto business at Cross River. Coinbase was one of my clients. We were looking to provide financing to these institutions. So nothing I'm saying out of school, but when I met with Celsius management after the very first meeting, I told my team we will never ever extend a loan to Celsius. Just that's them selling us, by the way, right? That's not even doing diligence. You can see, it's so obvious that this was a non-bank acting like a bank. What do banks do? They take in deposits, they rehypothecate, meaning they take deposits, they commingle, lend them out, they pay out interest. But banks generally lend against money good assets like houses, commercial real estate. What Celsius was doing was financing a hedge fund like activity. And by the way, that examiner report indicates that that flywheel, another name for it's called a Ponzi scheme. Okay. It's a Ponzi scheme. Now, the word Ponzi is used in that document. My interpretation is that Celsius's level of fraud is more egregious than FTX for the reasons you cited and more. And we have not seen Alex Mashinsky or his team be held to public account. We see a New York Attorney General inquiry and investigation, but we have not seen any public indictment. I would expect that. I think part of restoring trust in ecosystem is you got to hold people accountable. Now, Kathy, you had a few other questions there. Here's another shortcut to think about. Here are the warning signs. If you see a non-bank pretend to be a bank, be careful. Don't do that. That's BlockFi, Celsius, Voyager, and Genesis. Common factor, and they all blew up. So be careful of that. Coinbase is not trying to be a bank, right? Neither is Anchorage. By the way, Anchorage is a bank. So they have a better licensing and regulatory standard. Here's the second thing to look for. If you have an entity that issues a token, again, we saw FTX issue FTT, we saw Celsius issue Cell. Then the question is, are they using the proceeds of those sales to fund their business? And is it a critical part of their balance sheet? And that was true for FTX, and that was true for Celsius. Then that is a major red flag. That's a major risk factor. Look, the third is look at the quality of the management team. FTX had a former uh, compliance person that was involved with a poker fraud site. Celsius also had a very questionable management team, as well. So, and FTX had no independent board of directors. So there were quite a few warning signs. I have a thread listing 7 different warning signs out there. We can send you the link to that. Seek the highest regulated counterparty you can find, number one, or live in a fully decentralized world and then figure out how you manage your own security risk. So those are the two paths forward.
Okay. And would you say that if the yield is too high, if they're offering you too high a yield, then that is a red flag?
Yeah,
Or in some
look,
cases, is that okay?
if you don't know where the yield is coming from, you are the yield, right? So yes, it's a red flag. It's a concern, right? You have to really understand the and like I am sympathetic to the public outrage here because you can't expect a retail investor to be a credit analyst and ask these questions and do the underwriting, analyze this and that. This is very complicated stuff. You really have to know what you're doing. You got to be professional. By the way, that's why the securities laws exist. That's why this concept of registered securities exists. When you buy a security in the public market, if you buy Google, Tesla, Microsoft stock, there are all sorts of implicit reliances you have. There's an audit firm who is independent and accountable and subject to enforcement action if they do it right. There's an independent board and they're subject to liability. And that's just the tip of the iceberg. We take all of that for granted. Now, yes, the SEC can do better. Kathy pointed out a few things. I wrote an op-ed in the Wall Street Journal with former SEC Chair Arthur Levitt identifying how the SEC can improve crypto regulation. But this is the challenge, right? We're in a period of time where you've got actors that are not complying and don't have the right licensing model, and it's hard for an investor, especially 2 years ago when you had a 0% interest rate economy, to generate some yield. So it's a difficult state of affairs.
And just to clarify one thing you said if they're using the proceeds of their native token to fund the business, that's a red flag. Tell me why. What should
As
they
a
be using?
general,
Yeah,
as a
what should
general
they be using
matter,
it for?
as a general matter, like if you issued a security and using that to fund the business, as a general matter, that's you should pause and ask questions. I mean, I'm trying to think to myself right now. Look, there are a handful of successful ICOs, Ethereum being the most successful of them all, right? But Ethereum is very different. It's not a bank, it's a decentralized network. Have there been successful businesses? I'm literally trying to answer that question right now that have done an ICO that complied with the law. The list, if there is, the list is short and narrow, and certainly there's no one that raised with an ICO and then either conducted an exchange operation or a banking operation. That just hasn't happened. That Venn diagram is zero.
Okay, well, thank you for that. It's very interesting that Alex and his wife seem to be very visible on Twitter. I think I saw a picture posted by his family of Alex this morning with his son.
I
So,
I had zero money deposit in Gemini, Celsius, Blackfire, Voyager, but I've seen these movies before through the cycles of history and bad actors, and it'll happen again. But I feel disappointed. I don't know why there's no public account. It makes no sense to me. But Kathy, unfortunately, I've got to run. I'm a few minutes late
okay.
my next
Thank you,
one, but I
Ron.
did enjoy this.
Please, that's it for this edition of Crypto Defined. Please visit truthdow.news in the next few days. We'll have a recap of our conversation with Ram Ahluwalia. Thank you so much, Ram. Great to have
Kathy,
you.
all the best. Take care.